Okay, so today's objective is to wrap things up. I want to finish up our discussion of firms as options, thinking of firms as being call options and what that means for the incentives of bondholders and stockholders, what it means for the value of equity in a firm when two firms merge, or what happens to the value of the combined equity of the two firms when they merge. We'll wrap that idea up today, building on some of the concepts that we had developed on Monday and on Friday. Are there any questions about any of that content that was left over from Monday or Friday, or just about the course in general as we're wrapping up?
Professor Cook,
Yes.
is the fourth exam going to be the same format as the third exam?
Yeah, it'll be I think, yeah, five short questions, 10 points each. Answer 4 of 5. Second section will be 3 longer questions, answer 2 of 3. And I'm gonna make it the same format that I did for exam 3, where there'll be the questions available. I think there was actually a comment, I think, last time about the page skipping back up to the top. Is that true? Did people were experiencing that for exam 2, where the page would skip back up to the top? I thought I remember seeing a comment in the chat about that. So I think what I'm going to try to do is have the link be available, just so that's not happening, so it's not creating any unnecessary disruptions. I think I'm going to try to have like a link. You open the exam file will open up at 10 a.m. on Friday, and then instead of having the questions in that file, there'll be a link to an external file that will, like a Google Doc, that you'll be able to view, and I assume that'll take care of that problem with whatever glitch there was with the page in the exam file. So I'll have the questions probably in a separate file for that, and then again, you'll just upload your written responses with scanned images or pictures or whatever. Upload those to the Dropbox in that exam file. And so yeah, that'll, to answer your question, yes, it'll be this. I'm planning to have the same exact format as exam 3. I think that worked quite a bit better than exam 2.
Okay, thank you.
Yeah. So that's my plan for that. I'm going to send out some announcements about the final. We're going to try to do some automated proctoring method for the final, and so I'm just myself learning how this works. I got some training on it on Monday. I have some documents that kind of explain the process, and I'll try to send out an email soon about how that's going to work if you're interested in taking the final exam, which again is an optional exam, which can be used to replace any of your previous midterm grades. So I'm going to get that officially figured out. I think I've got it. I created a couple placeholder files right now, which you might have seen on Canvas, which represent the final exam. It's not the exam itself; it's just a shell that will take you to this platform called Examity, which will have some way to proctor your exam using like your computer camera and microphone, to kind of just monitor that you're not looking at other screens while you're taking the exam, and there's nobody over your shoulder telling you how to do the problem. So this is my first time using that, and I still haven't done it before, so I don't know how to do it from start to finish. So I'm gonna finalize those details soon and send out some announcements about that. To the question in the chat, that Examity online proctoring, automated proctoring, will be for the final exam, not for the midterm. And do the exam, yeah. So do the grades in Canvas, all the point values are the correct point values. The only thing that might be different is, well, the extra credit is currently being, it's not being distinguished in the Canvas gradebook as being an extra credit element. So right now that's being counted as part of your grade. So what's being displayed right now ought to be a lower bound on your grade. And once I'm gonna go in manually and make sure that all the grades are correct. I'll compute everybody's grades by hand, just based on the scores, to make sure that everything's weighted properly and everything's being counted in the correct way, whether something's extra credit or not. And so I'll do that before before the final. So then, yeah, if nothing else, what's being shown on Canvas is going to be a lower bound. So your grade can only be a little bit higher for making the adjustment that those extra credit scores are extra rather than required. Another question in the chat. Yeah, we have only 8 in-class problems. That's a little bit unfortunate. Partly a function of I think just some of the disruption of the transition between online and in person, and just having that be harder to administer those online. And so I've sort of shied away from that a little bit more. What I would plan to do for those would be, you have 8 out of 10. Typically those would be 10 points each. Typically those will be 10 points each. And so there would be 100 total points. Like I was planning on about 10 in-class problems. So that would be 100 points of your score. I'll probably just scale up. The 80 points, multiply everything by 5/4 to get from 80 points to 100 points. And that'll be your in-class problem, set grade. So it'll be a little bit, that might be another adjustment, but that'll be really minor. Each of those problem sets are only 1% of your total grade. So I don't expect that weight adjustment to be very consequential. And there are extra credit opportunities if you wanted to make up those. So the question, the automated practice test in Canvas. So that's another placeholder file that I created so that we could get some, like, you could do a trial run. You could like log in advance, try to just make sure that you can set it up properly. It won't be like an actual exam. It'll just be the form of the exam with the links and everything like that you have to do to get into the Examity site. That'll just be there so you can do a trial run to make sure that works for you before the final on Monday. So that's what the automated practice test is. One of those is a placeholder for the real one, and one of them is a placeholder for just the practice, or the trial run version. And then another question in the chat, extra credit is worth 10 out of 0. Yeah, so it'll just be whatever points you get will be added to your score, and then the denominator is 0 because it's not going to add anything to the denominator because it's extra. So it doesn't count as part of the 1,000 total points for the course grade. Yes. Yep. Yep. Good. Okay. Okay. That's all I'm seeing for right now. All right. So we'll wrap up this this idea of evaluating mergers as in the same way as we would evaluate options. What we're going to see is that in reality, mergers essentially have to generate some synergy for them to be worthwhile for the stockholders. If there's no synergy, so if this number one point here doesn't hold, if there's no synergy, then we're going to see that a merger which reduces the volatility of cash flows actually reduces the overall value of stockholder equity. It actually destroys equity value. It's not in the stockholder's best interest, and that's basically based on this principle right here. So this is what I'm going to use just to explain this idea that the volatility of the underlying firm, the volatility of the cash flows of the firm, affects the intrinsic value of the option, and therefore it affects the value of a merger if the merger affects the volatility of cash flows. So let's think about a call option that's going to have an exercise price of 110. So this call option can be exercised at any point between the present day and some future expiration date. Let's just consider two cases. In one case, there's a 50-50 chance that the stock could either be $80 or $100 just before expiration, right? The exercise price is 110. So in this case one, when there's a 50-50 chance of the stock being equal to $100 or equal to $80, the intrinsic value of that option, if the value of the stock is $80, the intrinsic value of the option is worth 0, because the exercise price is 110, and so you have the right to buy it at 110, but it's currently priced at 80, so you'd never exercise that option. So the option itself is worth nothing to you, because the exercise price is higher than the current price at the time when you were thinking about exercising. Again, if in case one, if we have this other 50-50 chance of a $100 value of the stock at expiration, again, the $100 current price is less than the exercise price, and therefore the intrinsic value of the option is 0. So the intrinsic value in this case, it's just the value of the option at any particular stock price, the value of the option under any contingency, any state of the world. We have, in this case, we just have two states of the world. It could either be $80 or $100. The intrinsic value of the option is actually $0 in either case, because in both cases the current price is less than the exercise price. Okay. We're going to consider the exact same option. It's the same stock. Well, it's the same stock, except for this one is going to have a wider spread in terms of what its price could be. But we still have a call option on this stock, and the exercise price is still 110. Here, the stock has a 50-50 chance of being either 60 or 120. This expected value. This expected value is still $90. It's still on average going to be $90, at least in expected value terms. but the spread is wider. Now there's a 50-50 chance that it's either $60 or $120. And now we can consider, for this case too, we can consider what the intrinsic value of the option is under these two contingencies. So this contingency, the stock is $60. In that case, the intrinsic value of the option, that's just zero because, again, the stock price is less than the exercise price. You would never choose to buy the stock at 110 when you could just buy it at 60. Now, with case two, if the exercise, or if we're in a state of the world where the value of the stock is 120, the intrinsic value of that call option, in this case, is $10 because we have the right to buy at 110, and the actual value is 120. So if we wanted to, we could exercise the option, buy the stock at 110, and then sell it at 120 for a net gain of $10. So that the intrinsic value of the option in that case is $10. Nothing's changed about the expected value of this stock in the future. The expected value of the stock is still $90, but case two has a wider range of possibilities, a wider spread between the different outcomes than case one does. There's a $60 spread in case two, whereas there's only a $20 spread in case one. And obviously, if the intrinsic value of the option is zero under both contingencies, then the expected value of that option is zero. However, if there's some contingency where the intrinsic value is something above zero, then this would have an expected value of $5 if these scenarios are both equally likely. So the intrinsic value of the option goes up as you move from a case that's more stable, less volatile, as you move from that case to a case that's more volatile. All right, so let's think about this in terms of firms. This is going to bring together what we just know, or what we know about options from the stuff we just covered in theory, and then also our recollection that the firm can also be characterized as an option, or the stockholders can be thought of as holding a call option on the firm, where they get the upside of the firm, of owning the firm when the cash flows of the firm are high, but they have a lower bound at zero, where if the cash firms are not enough to meet their debt obligations, then they declare bankruptcy and they don't lose any more than simply what they owe to bondholders, or what their cash flows are, which are able to pay the bondholders back. We went over that with this example here, where if the cash flows exceed the debt obligations, they get the residual. If the cash flows don't exceed the debt obligations, then they have a zero payoff as their lower bound, just as a call option would. So we're going to combine this together. We've got, in this case, we're going to be thinking about a merger between SolarCity and Tesla. Tesla obviously produces electric cars. SolarCity is a solar panel production firm, and so there was some ideas about how the merger of these two firms would create a more vertically integrated firm that would be able to take advantage of organizational efficiency by being all under one umbrella rather than two separate firms, because their products are so codependent. So we're going to just evaluate this merger using the Black-Scholes model for pricing options. We're not going to go into the details of how the Black-Scholes model works. We're just going to apply it to this particular situation and show what happens to the value of the firm's equity what happens to the value of the firm's equity after this merger occurs, which reduces the volatility of the firm's cash flows. So let's think about the balance sheets of these two companies individually. So we have Tesla's balance sheet on the left. We have SolarCity's balance sheet on the right. Tesla has 1.08 billion in equity, 2.7 billion in debt. SolarCity has 220 million in equity and 2.4 billion in debt. And the variability of their returns on assets, you can think of this as like the earnings before interest and taxes relative to the value of the assets of the firm. So these returns, these earnings potential, have a variance, or a standard deviation of 40% for Tesla, 60% for SolarCity. So they're both somewhat variable. SolarCity is a little bit more variable than Tesla's is. I'm just going to point out that the value of the combined equity here, this is, if we add together this 1.08 billion of Tesla equity plus 0.22 million or 0.22 billion of equity for SolarCity, that's going to give you about 1.3 billion of combined equity if you just add the value of the equity together for each firm individually. Now we're going to consider a merger. There's going to be a merger of these two firms. What this is essentially going to do is combine the balance sheets of each of these firms together. So they're going to be, you have the debt gets combined, the equity gets combined, but it's not exactly the case that the value of the equity of the merged firm is the same as the sum of the individual equity, and that's because of the asymmetry between the upside to equity holders versus the downside to equity holders. Remember, equity holders have a kind of an upside of whatever cash flows minus debt obligations as their upside, but their downside is just zero under the ability to declare bankruptcy in the event that the firm is falling on under bad economic conditions. So we're going to evaluate this under no synergy first. Now the critical point here is that the standard deviation of returns of this merged firm, of this joint firm, is going to fall to 30%. Remember, it was 40% and 60% for the two firms individually. This is an example of the diversification effect. You remember how we could take two risky assets, combine them together in a portfolio, and actually see that a portfolio could have a lower standard deviation than any of the individual standard deviations. There could be some diversification effect where the covariance between the risks of the stocks could be negatively. They could have a negative covariance, or they could be negatively correlated, in which case a portfolio could actually be less than any of the individual points. We had this sort of shape where, if this was risky asset A, this was risky asset B, there could be a portfolio where there's some other combination C which had a lower standard deviation than either of the two separate assets. The same thing can occur for firms. Firms are just bundles of future cash flows and debt obligations. So in the event that the standard deviation is reduced, these cash flows get less volatile, and thinking back to our idea of firms as options, we know that as options get less volatile, as the the spread or the volatility of an option goes up, the actual the actual intrinsic value of the option goes up with that volatility. Conversely, if the underlying volatility of the asset goes down, the value of the call option goes down. And that's the exact logic that's going to apply to firms in general, where stockholders are going to be hurt by a merger that reduces cash flow volatility, whereas bondholders are going to gain because they're going to be more likely to be paid back because the cash flows are less volatile. It's more likely that the firm will have enough cash flows to cover their debt obligations. Okay. This part here is a extremely complicated formula. Suffice it to say that this is a formula that was developed, which actually shows you the correct way to price an option, given that there's some time between the present day and when when the option expires, and given that there could be some, you have the underlying stock, you have time, you have the stock price on the vertical axis. The stock price could be going up or down. You're sitting at time zero. Maybe the option expires here at time t. You don't know exactly what sitting here at time zero. You don't know what the price is going to be at time t, so you don't know what the value of the option is. But there's actually a way to derive that, which again is very complicated. It has to do with the fact that ultimately it has to do with the fact that you can combine, and you can read this in the book has a little bit of a simpler or an explanation of this, of a simple case of this on page 688 of kind of where this Black-Scholes model comes from. One of the things they do is they show that you can always duplicate the payoffs to a call option with a combination of buying the stock and then borrowing some amount at the risk-free rate. You can combine those two activities to duplicate the value of a call option, or the payoffs to a call option. And then they use some stochastic calculus, and it's way beyond the scope of this class. What's important though is that this is the formula that's been derived and proven to be the efficient way of pricing options. And so if this is the efficient way of pricing options, if this Black-Scholes model is able to price options, if this Black-Scholes model prices options and firms, or the equity, I should say, if the equity is a call option, which we've seen before. So if the Black-Scholes model can price options and equity is a call option, then we can use, this is really the train of logic here. So if this Black-Scholes model is the way that we price options, and we can think about stockholders as owning a call option on the firm, then the Black-Scholes model, by implication, can be used to price the equity of the firm. If it can be used to price a call option and equity is like a call option, then the Black-Scholes model can be used to price equity. And this allows you to see how equity value changes as the underlying volatility changes. So what this is going to involve, this model has a couple of different functions embedded inside of it. This ND is the function for the standard normal distribution where, or the cumulative standard normal distribution, where if D is some standardized random variable with normal distribution, then the probability that some value is less than this threshold D is given by the area below this normal curve, the standard normal curve. It's symmetrical around 0. That's one of the functions that's embedded in this model. That's a way to capture the variance. The variance of the underlying stock is embedded in that equation. I don't want to go too much too deeply into that, because it's not going to be important for you're not going to have to use that formula at all, except to know that it's a way to price call options. We're just going to use this idea that we just saw kind of earlier today, and then also in the previous sections. This idea that a call option that is deep in the money, that is a call option where if the exercise price, say, is 100 and the current stock price is 150, then that option has intrinsic value, but it has even less intrinsic value than if the underlying stock was worth $200 and the exercise price was only 100. So if there's we have this value of the call option, which increases as you get further and further away from the exercise price E. So if you're at price, if the exercise price is 100, then if the underlying stock is worth 150, that option has a certain value. If it's 200, it's deeper in the money. If the underlying stock is 200 rather than 150, we're even deeper in the money than before, and so that option would have a higher intrinsic value. So it gets more valuable as you get deeper into the money. However, there's an asymmetry here, where if a call option is deeply out of the money, where the stock price is say $50 or $10, right? If we have an option that has an exercise price of 100, and we think about two different prices of the underlying asset, 10 and 50. If the underlying asset is $10, we're deeply out of the money, but the call option is still worth 0 at $10 and at $50 the same way. So a call option that's deeply out of the money is worth the same as a call option that's only slightly out of the money. So there's an asymmetry, and that's the key point. That asymmetry is the key point that makes the value of equity sort of get diminished as the volatility of cash flows goes down. Essentially, this Black-Scholes model. In this model, the variable S is the stock price. This is referring to stocks typically. S is the stock price. E is the exercise price. N is that standard normal distribution. D are some of these parameters, which are the stock price, the exercise price, the risk-free rate of return, the variance, the underlying variance of the stock. Okay. Now we can actually exactly represent this this model as referring to a firm if we just swap out the stock price. If instead of thinking about this as the stock price, if we think about this as the value of assets, of the firm's assets, and if we think about the exercise price as the value of debt, which we saw we could do that as we were thinking about the firm being a call option. If we swap out the stock price for the value of assets and the exercise price for the value of debt or the debt obligations of the firm, we can combine that with knowledge of the risk-free rate, the variance of returns, the years until expiration date, and we can plug in those parameters for the firm. We can plug in the value of assets for S, the value of debt for E, the risk-free rate of return for R, the variance of the firm's cash flows. That would be put into this this sigma squared. T in this case would be the maturity date for the debt. In an options framework, this would be the years until expiration date, but in a firm valuation framework, this would be the years until the debt matures. If we plug in those parameters, we can actually use the balance sheet parameters and the variance parameters from the Tesla and Solar City example. And this is kind of a black box because we're not you're not going to have to know that Black-Scholes formula, but just trust me that when you plug in those firm parameters that were the value of each of the assets, the value of the debt, the volatility. Recall that 1.3 billion was the value of equity in the case where we were just adding up the individual equity values. That was when we just took the equity of Tesla and added it with the equity of Solar City. That was a 1.3 billion of combined equity. Now, when you apply that options pricing model, remember the variance of the cash flows has decreased, and so that's going to decrease that option value according to this Black-Scholes model, and also according to this intuition that an option that's way in the money, that's far in the money, that's deep in the money, that option is going to be more value than an option that's less in the money. But if it's out of the money, it's just a lower bound of zero. It's not worth even less the more out of the money that it is, and that's what makes these payoffs asymmetric, and that's what actually works to reduce the value of equity in the case that the firm's cash flows get less volatile. So the variance goes down, and if you plug in those firm parameters, the assets, the debt, the risk-free rate of return, the underlying volatility of cash flows, you plug those into the Black-Scholes model, you'll find that the equity actually goes down to 1.2 billion under the scenario where the firms are merged together. So there's actually a destruction. There's a destruction of $100 million for equity holders. In a sense, what happens here is that stockholders end up implicitly reducing the risk to bondholders and thereby increasing the payoffs to bondholders. So this merger is essentially, by way of reducing the volatility, it's reducing the expected payoff to stockholders and increasing the expected payoff to bondholders. So the question in the chat, the Black-Scholes model, you're not going to have to actually plug in numbers to apply the Black-Scholes model. It's just some intuition for thinking about firm valuation. It's a means for valuing firms, which can be, it's a useful tool for doing that when you can make the comparison of firms being call options. So you won't have to actually solve a Black-Scholes model problem on the exam. It's just a tool that is used in finance that you should be aware of. So essentially, if you think about this from the perspective of stockholders, they are, by merging, they're implicitly subsidizing bondholders due to the fact that the cash flow variability of the firm goes down with this merger. And so for this merger to make sense for stockholders, there would have to be a lot of synergy to make up for that. Not that there could never be a good reason for stockholders to want a merger. It's just that there's an implicit bias against it. There's an implicit barrier that has to be overcome for a merger to be worthwhile to stockholders. Mergers essentially just destroy equity. It's only 100 million in this case, which is you know, a relatively small percentage of the overall equity, but it's still a lot of money. That equity gets destroyed, and essentially it's a transfer from stockholders to bondholders. It's an implicit subsidy to bondholders, and so for stockholders to prefer that merger, they would have to expect quite a bit of synergy in order to make up for that loss. Bondholders are the ones that would benefit as a result of the cash flow variability decreasing. Okay. So we talked about how, you know, as an investor, diversification is helpful. It lets you, you know, reduce the volatility of your portfolio. In this case, because we have two different parties, one which is equity holders, which capture the upside, and one which is bondholders, which don't capture any upside, which could capture the downside. There's a difference in terms of how those two parties benefit. We have a merger that's purely for diversification purposes. Diversification purposes. That's just going to enrich bondholders at the expense of stockholders. Whereas, you know, stockholders inherently would prefer to have more volatile returns, because it means that they are more likely to be able to capture the upside of their equity, which, if we think back to what a call option is, that would be the more volatile returns are more likely to be deep in the money. They're more likely to be like a deep in the money call option and benefit equity holders more. Whereas if the firm is doing badly, their lower bound on their payoff is equal to 0. Okay, so this unit has kind of just summarized how you can reframe a firm as being a collection of call options and put options. We saw how the equity on a firm is like a call option to the stockholder of the firm. That's only the case, though, if there's some debt. You know, the debt in this case is like someone loaning the firm money is like someone that's sold a call option to the equity holders. And so if there's no debt, then there's no way in which the firm is like a call option. So it's only levered firms that are like call options. And then we can understand one framework to understand the payoffs to mergers is to evaluate the firm as a call option, consider how the merger affects the volatility of cash flows, use the Black-Scholes model, and you can figure out how equity value is either created or destroyed as a result of a merger or maybe a separation, right? If you're curious about more about that, there's, you know, chapter 22 has some more examples on how to think about firms as options. But we've covered the main points of that, and the key takeaway is that mergers, if they only diversify, if they only serve to reduce the variance of the returns, but they don't do anything to create synergy, they're going to be a benefit to bondholders and a loss to stockholders. Okay, so that's kind of the main takeaway from this section, this lesson, and it's a way to evaluate mergers using some of these options concepts that we've learned. Now I want to mention too, I put up some extra problems. So I put up like I put up some extra options problems just to give you guys some more practice. There weren't that many options problems on the practice problems that I had originally posted. So I wrote a new one yesterday, a new problem on options theory. I also put the solutions up to that, so you can work through that, as well as Modigliani and Miller. You know, this was a key concept. Modigliani and Miller Proposition 1 was really a key concept that was used all over the place in Lesson 9 to consider how the value of the firm doesn't change under leverage. I created a new problem for that as well, which walks you through a little bit more complicated example than what I had on the slides. And I think it illustrates a little bit better than what was on the slides about how the firm value actually can't change under a firm issuing debt. How if it does change, if the firm value does change, there's automatic incentives for people to flee the stock of that firm, and that's going to drive the stock price down, basically back to where it was before. There's a problem on that. Modigliani and Miller practice problem or review problem on Canvas as well with solutions. So I'd encourage you to look at that as you're studying for the exam. I think that this MM1 is such a key concept for lesson 9 that I thought it was worthwhile to create a problem for that, to just hammer that concept home so that was a little bit more clear. So that's available on Canvas with solutions. The options problems are available on Canvas with solutions. There's also the other practice problems that I posted a couple days ago. I think it was on Sunday. So that's all there for your benefit in getting ready for Friday. Are there any questions about anything else here before we finish things out? Okay. Look, guys, I'm really sorry we couldn't have finished this semester out in person. I thought it was a really fun class. You know, the first 8 weeks there was a lot of questions, a lot of engagement, and it would have been really fun to be able to continue to do this face to face. You know, all being in the same room, being able to actually see one another. But it's been a fun semester, and I appreciate you guys' engagement with the material. And let me know between now and Friday, or between now and next week, if you have questions about anything. But thanks for the good but weird semester.